Good morning and welcome to today's Premium Account Market Update. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, current Managing Director of Investor Signals. I have over 17 years of experience in the financial services industry as a licensed securities and derivatives advisor. The format for today's presentation, it's a quick look at the macro update driving equity valuations. We roll through the ASX top 50, in particular looking at those companies that have just reported their March quarter production updates in respect to the mining companies and the earnings updates in the context of Stockland's, Brambles, ANZ. We've seen announcements out of Mirvac and a handful of other companies that I'll speak to as we roll through the top 50 stocks and look at those names that we're building portfolio allocations around and our recent transactions. The services that we provide are based around a premium account service. We run a model equity portfolio of ASX top 50 stocks. We use call options to enhance portfolio returns. The asset allocation is focused on effective ownership around ex-dividend dates, and we aim to generate above cash flow through the call premium dividends and still providing for some capital growth. The portfolio is managed under a strict investment mandate, which is suitable for self-managed super funds, and importantly, the assets all remain in your name. If you'd like more information, please contact myself, Leon at investorsignals.com. Up on screen at the moment is a graph of the US Dow Jones Index, and this obviously represents the top 30 companies in the US. We're seeing US companies conclude the March quarter earnings. The interesting part was in the December quarter, US earnings accelerated to probably the fastest pace that we'd seen over the last number of years, with earnings growing at around 10% on the same previous corresponding period. Now, we're not seeing that same growth run rate flow through in this March quarter, but on an annualized basis, we're still looking for US earnings to grow at about 8 to 10%. From an economic data standpoint, we're seeing the Federal Open Market Committee announce that the Fed would continue to reduce its stimulus program, so a further $10 billion coming out, taking it down to $45 billion, and they've highlighted that they intend to keep the Fed fund rate unchanged at zero, and we're probably the market's pricing in interest rate rises in the US in the mid part of 2015. At the moment, the 10-year treasuries that I looked at in last week's recording are still tracking at around 2.6%, so there's no real evidence of an uptick in the yield yet in the US, and I think probably that fits into our base case that equities largely consolidate and move sideways over the next 3 to 6 months. Hopefully we see better economic data coming through from the US after the winter, the extreme winter weathers that they had, and we've seen that impacting their GDP numbers that have just been printed overnight. But as we've seen, the US market still went up in the face of that negative GDP data and the withdrawal of further that 10 billion stimulus. So the market's pretty optimistic that the accommodative federal fund rates and the stimulus that central banks are providing will continue to lead to improving global GDP as we start to see synchronized growth, which is our base case, come through towards the back half of this year, which should underpin equities to move higher after this consolidation phase that we're looking at. From a valuation standpoint, US equities trade on less than a 2% dividend yield, trading at around 16 times, 17 times forward earnings. So they are expensive, and it is necessary for them to deliver that 8% earnings growth. In the absence of that 8% forward earnings growth, US equities are probably worth 10% less than where they are at the moment. But again, our base case is that this is probably no more than a 20% probability that the market pulls back to these levels. I think consolidation and a move higher is the most likely course from where we sit at present. On the domestic market, we're trading 15 times earnings, a little over 4% dividend yield. The expectation is for the Australian market to deliver about 7% earnings growth. As I roll through the top 50 stocks today, we'll focus on which names are likely to underperform or overperform that benchmark. Starting off with AGK, so looking at some numbers on this, current numbers on a 4% dividend yield, trading 14 times earnings. They delivered fairly disappointing earnings numbers in the 2013 year, and we're looking for fairly flat numbers into 2014. The growth for the company may kick in the 12 months ahead into the 2015 financial year. The market's expecting about 10% earnings growth. They were expecting that in 13 and it didn't deliver, and again in 14 and it didn't deliver. So I think the probability is that we get further consolidation here in AGK. So we own this stock. We've taken the opportunity to sell the covered calls. The call premium combined with the dividends generating over 10% cash flow. We're looking for AGK to consolidate, and maybe it's a 2015 recovery story where it moves from sort of this $16 resistance that it's been in for the last year or so, and finally breaks up into the price range sort of from $16 or $18 from 2015 onwards. Asiano, so this is a name that I'd spoken about for some time, saying the only sort of positive sign here is that the company's like to increase their dividend payout ratio. The company announced that from sort of the current 35% payout ratio, they'll be kicking that up to around 60-70% payout over the next 2 to 3 years. We haven't seen a substantial reaction in the share price. I think that reflects that the market had already priced that in, so allowing for the dividend increase still only puts a stock on 2015 of about 3% yield and about 13 times earnings. They disappointed during earnings season, so whilst the market's looking for 10% earnings growth, I think there's some reservation around whether the company will deliver it. There's a strong focus on cost control, and the company's management's comments highlighted that the Australian economy is still tough, which probably doesn't feed into commentary that would see earnings meet or exceed market expectations. So I think the base case here is it consolidates and moves sideways at around this level. But certainly, again, coming into 2015, as the yield picks up to in excess of 4%, it becomes interesting. But even at 3% and 0 to maybe 5% earnings growth, there's better opportunities elsewhere in the market. So it's on the radar, but not doing anything there at the moment. Amcor, the more I look at this, the more I start to see value again in Amcor. We've been buyers of it off this $10 support level here. The stock's on a 4.5% dividend yield, should grow earnings at about 8 to 10%. But I think with the Aussie dollar up here at 93 cents and Amcor holding up at these prices, I think it provides a defensive addition to a portfolio, in that if we were to see the Aussie dollar fall, we could see Amcor earnings tick up, given that 85% of its earnings are generated outside of Australia. So I think Amcor could trade up to maybe 10.75, but ultimately, just on a 3 to 6 month outlook, we need to be selling the covered calls to complement that income. But I think on a 2 to 3 year outlook, Amcor can consolidate over the next 6 months and could easily trade much higher again, back in sort of that $11 to $12 range. So we look to continue to add exposure to portfolios in Amcor. AMP not being there at present. ANZ came out with their earnings result, reaffirmed an 83-cent dividend. The underlying earnings, albeit I haven't had time to go through the results in great detail, look to be growing somewhere around that 5% benchmark that across the banking sector in general the market's been anticipating, but I'll review that and provide further commentary next week. Our strategy here on ANZ is essentially we own it at lower levels. We've sold the covered calls. At this stage, the reaction to the earnings results supports the fact that we've sold the covered calls. We'll collect the upcoming dividend, and I think we'll look for ANZ really to consolidate somewhere at or near these current levels. Commentary out of the company indicated that the Asian business sector has delivered strong earnings growth. ASX, as with Amcor, the more I look at this one, I like it as well. ASX, on a forward basis, should grow earnings at about 8 to 10%. The stock trades about 18 times earnings on a 5% dividend yield. I think this is a good defensive addition to portfolios. It makes sense to own it here, sell the covered calls, drive 10 to 12% cash flow, and provide some capital growth up to around $38 as a maximum. But I see this one really consolidating, moving sideways, but it's a defensive mix with a high probability of some corporate action in the near future where another takeover offer is put on the table for ASX. AZJ came out today with good production or good haulage numbers, which supports the underlying earnings growth expectation of the company at about 20% earnings growth. We like the name. I think the stock, as I'd spoken about, is just getting a little expensive. I think sort of any opportunity to pick it up at around $5 is good buying. $5.50 is probably resistance. We largely see it consolidating in line with our view for the market over the next 6 months. BHP, we've seen iron ore prices pull back to recent lows from going back 3 or 4 months ago. Iron ore was trading at about $140 a tonne. Now it's back down to $108. We're seeing some pretty negative housing data come through out of China in the first quarter of this year, albeit the flip side of that is the multinationals in the US, so the S&P 500 companies that have large business exposure into China, are not seeing a softening in their earnings trends out of China. So whether we're at the early stages of a ongoing slowdown in the Chinese housing market, we'll have to wait and see. But we've broadly exited most commodity exposure in portfolios. The only stock we're holding is BHP. And the idea here is we own BHP. We're selling the covered calls up at around $39. We're collecting the premium. We're collecting the dividend. The company's likely to announce a share buyback program in the second half of this year, and that should continue to underpin the price, which is why we're happy to keep that exposure to BHP. From a forward earnings outlook, I think if you factor in spot prices and the fact the company delivered pretty uninspiring growth out of their energy portfolio, I think base case is BHP consolidates and moves sideways. Brambles delivered a result that was in line with expectations. The underlying business growing at about 7%. Again, I think this theme where we get exposure to some US dollar earners with the Aussie dollar where it is at the moment makes sense. So I continue to like Brambles. Happy to even buy it here around $9.50. Look to sell the covered calls up to around the $10.25 into the early stage of next year. Collect the August dividend and maybe even look to collect that March dividend, but continue to like Brambles. CBA, not think there at present. To the extent that we own it, we've sold the covered calls up here at around this 78, 79 level. Coca-Cola, reasonable value down here from a yield perspective. Obviously, the company's had a series of earnings downgrades, and we're looking for the stock to find support. It's on a 6.5% dividend yield here. As it comes into its dividend in August, if we can see the stock trade back up to around $9.70, we'll take the opportunity to sell the $10 calls just to complement some cash flow and drive that dividend yield from sort of 6% up to around 10 to 12%. But looking for the stock ultimately to put in a base over the next 6 months. Not computer share, so again this comes back onto the radar, centered around this view that the Aussie dollar, if it was to come off, we could see additional support in some of these names. From a valuation standpoint, computer share still looks the most expensive out of these US dollar plays at about 20 times earnings and on a 2.5% dividend yield. But again, of the view that it's probably most likely to consolidate and move sideways, while still have the opportunity for some capital growth. So even buying in at this level and selling the covered call makes sense again for computer share. As to CSL, I think from here back up to around $72 is most likely for CSL. The company should deliver about 8% forward earnings growth. Crown, I think, becomes interesting again. Our target was sort of back down below $16. So probably somewhere around this sort of $15.50 to $16 I think will end up being support for Crown. GPT, after owning this at lower levels, are just taking the opportunity now to lock in some profit on GPT. The REIT sector has been the best performing area of the market over the last month or so, up roughly around 5%. So our strategy of sort of adding exposure in GPT, Stocklands, Lendlease has all delivered good returns for portfolios, but I think at these levels we start to look to lock in some profit on GPT. The underlying business should grow somewhere around that 6 to 7%. IPL, interesting. I think we're probably looking at a support level again here in IPL. The stock trades about a 4% dividend yield. The market's looking for about 20% earnings growth into F year 15. That would put the stock on about a 5% yield and 10 times earnings. But I think sort of this long structural downtrend that IPL's been in, we're probably looking at the reverse of that now. And I strongly suspect that we're facing a period, and I'll just drag this into position here to reflect sort of my view that I think IPL will probably find support here and start to move higher. So we look to add IPL to portfolios at or near these levels. Lend-Lease, just locking in some profit after the run, after owning it at lower levels here, up at these levels. I think it's just a little expensive, and to put some numbers on that, it's about 14 times earnings, about a 3% dividend yield, and the market's looking for about 7% earnings growth into 2015. Certainly into 2016 and 17, we're likely to see Lend-Lease deliver low double-digit earnings growth, somewhere around 11 to 12, 13% earnings growth, and in that environment can move higher. But across the next 6 to 12 months, I think we're probably more facing a consolidation at or near this price point in Lend-Lease. NAB, in line with all the banks, I think 5% earnings growth at a 5% dividend yield, 5 to 5.5%. They're unlikely to travel too much higher. I think we're in consolidation and move sideways. So owning these names, selling the covered calls and collecting the dividends and boosting that cash flow up to around 10 to 12%, I think will deliver some outperformance, as the probability is they consolidate and move sideways in line with the rest of the market. Origin, I think this is a reasonable opportunity as a defensive buy right. So I think if we were to go out 12 months, we'd like to see Origin move back to delivering 10% earnings growth. The stock trades at the moment at around 19 times earnings, so it's quite expensive on a 3.5% yield. But as we get into the F year 15, and if it was to deliver sort of 10% earnings growth, that drops back down to around 16, 17 times earnings. So even to own it at these levels, sell the fairly tight covered call, collect the August dividend, and try to ratchet up that call into 2015 as we would expect to see Origin break out of the current trading range and trade higher into sort of the middle part of next year. Oil Search, we continue to like in general Oil Search, Santos and Origin. Stockland, so again, this is one of those property plays that we own it at lower levels. We've started selling the $4.10 calls out until the end of December. The company's reaffirmed that underlying earnings growth is going to be around 6%. The company's on track to deliver their 24-cent annualized dividend, so we'll collect 12 cents of that in the June period. Combine that with a call premium, again, we're driving that from sort of a 6% yield up to around 10 to 12%. Plus providing that capital growth opportunity from owning it at lower levels up to $4.10, but I don't see the stock moving too much higher than that. Sonic, I continue to like this. It's a defensive name, trading at around a 4% dividend yield, looking for about 10% earnings growth. Owning it here, and we're selling the 1850 calls into the back half of this year. Again, driving that dividend from 4% up to around 10 to 12% and providing some capital growth. Santos, I think, provides value down here, and we've been buyers of it at around this 1350 level. We've collected the premium from the 1450 calls over the last month or two, and we look to resell those again into the back half of this year, and that sort of, again, drives that cash flow up to our target of 10 to 12% and provide some capital growth from around this 1350 to 1450 level. Transurban, we own this name at lower levels here. We've sold the covered calls up at around 725, and I think we should be sort of fairly safe that the stock consolidates below that. Those calls come off at the end of June. We collect the June dividend, and we'll have the opportunity to ratchet those calls up a little bit higher into the back half of this year. But we continue to like Transurban and see it as a sort of buy on the dip opportunity here. Telstra, so I've taken the opportunity now to sell the covered calls. They're 541 Europeans out into December, so we'll collect the August dividend. Underlying earnings growth for Telstra should be around 3 to 5%, so I don't see the stock trading too much above 550. Even at current levels, that puts it on a 5.5% dividend yield, and I think it should start to run into some resistance and unlikely to compress too much below that. Toll, flat earnings is the outlook here for Toll, so we're happy to own it at or near these levels. Sell the tight covered calls. Don't see the stock trading too much above $5.50. From a yield standpoint, the stock's trading at about 5.25%. So Westpac, NAB, and ANZ all come into their earnings results and ex-dividend period in the course of May. Our strategy here with Westpac is we own it at lower levels. We've sold the covered calls up here around 35.50. We'll collect the upcoming dividend, and through that added income from the call premium plus the dividend, we're getting around 10 to 12% cash flow, and I think it looks like we've set that call level at probably the right point, in that the stock's likely to consolidate below that strike level in Westpac. WDC, I think this makes sense within the property play again. Exposure to US dollar earning revenue. The stock trades somewhere at around 5% dividend yield, 16 times earnings. We've got the upcoming spin-off of the Australian property assets as they get rolled into Westfield Retail. I think out of the two, our strategy is look to rotate out of Westfield Retail and keep the exposure to WDC. On a forward earnings outlook, the company should grow about 5% earnings into 2015, and that would put the stock on about 15 times earnings and a 5% dividend yield. I think their strategy of owning, consolidating their portfolio and focusing on major capital city centres is the attractive play over a sort of 3 to 10 year outlook within the property space, so I continue to like WDC. Wesfarmers, so we've rotated out of Woolworths into Wesfarmers. So from an earnings standpoint, Coles delivered earnings growth that was probably below expectations after Coles delivering high single-digit earnings growth in the recent quarter. We've seen that come back to around 4% earnings growth. Bunnings was the standout performer in their third quarter results. From a valuation standpoint, Wesfarmers, as I've spoken about, is expensive. It's about 19 times earnings, but a defensive 4.5% dividend yield. The underlying business growing somewhere around 5%. I think the stock's still a buy at these levels, and we sell the covered call up at around this 44.50 level. So we're collecting that call premium, collecting the dividend, getting the 10% cash flow, looking for the stock to move sideways. If we were to go out another 12 months, I could see Wesfarmers gradually starting to move a little bit higher and trade into a new range again. If from a FY15 perspective, the market's looking for the company to deliver about 10% growth, and that'll put it back on a 5% dividend yield. But happy to be a buyer of Wesfarmers in the current market at or near these levels. Woolworths delivered their earnings result. The market was looking for something around sort of 6%. The underlying growth in Woolworths food and liquor was a little bit below expectation, but it did come in slightly above that of Wesfarmers, roughly around 4.4%. From a PE standpoint, Woolworths expensive, about 19 times earnings and a 3.8% dividend yield. My target here on Woolworths is that the stock consolidates back at around 35.50, and we're probably happy to take another look at it as a buy right off that 35.50 support level. Woodside Petroleum, we're just starting to lock in some profit here on on Woodside Petroleum. The stock trades about a 5.5% dividend yield, about 14 times earnings. On a forward outlook, we're looking for fairly flat earnings growth, but the company is very disciplined around cost control and where it ultimately ends up focusing its reinvestment in the oil and gas space. So our expectation is, whilst I think short term it's probably the catalyst for the stock to really run too much higher is diminishing. The results out of the March quarter production numbers, the highlight across the resource space was certainly Woodside Petroleum's production number. Production was up from the Pluto project there in West Australia, and also the price that they were achieving there was above market forecast. So that's essentially what's been responsible for this kick from sort of 38 up to 41. But at these levels, I think the stock consolidates. And WRT, again, after owning it at lower levels, we look to take some profit up here at around this 320 level and look to rotate that capital back into WDC as our sort of preferred outlook as we start to skew portfolios again, focus on these US dollar earning companies that will provide some defensive earnings characteristics if we were to see the Aussie dollar come back under pressure again. And the catalyst for the Aussie dollar to come under pressure is probably as the US economy moves into its summer period and we see a pickup in US economic data. We'll start to see those yields in the US push back up, and that should start to put pressure or strengthen the US dollar and inversely sort of put some weakness back on the Aussie dollar. So we start to rebalance portfolios around, again, some of those US dollar earners. Thank you for listening in to today's recording. If you'd like to know more about the Investor Signals Premium Account service and how we can work in partnership with you to manage your portfolio, please contact me either on the email address on screen or on 0292388188.